How much can I borrow for an investment property, and how much is the minimum deposit lenders accept are the two most commonly asked questions from newbie property investors and even regular property investors who are looking to grow their portfolio. So the answer to those two questions will vary, obviously, depending on your financial situation and other factors. So this video will explain those factors and hopefully help you determine how much you can borrow without overstretching your financial capacity. So how much are banks willing to lend for an investment property? Banks and other lending institutions, because there are other lending institutions that aren't banks, prefer to lend no more than 80% or 70% for commercial properties, but they will go as high as 95%. If you go higher than the 80 or the 70%, then you will be charged lender's mortgage insurance, which is a fee to the banks or to the lenders to cover them for the extra risk that they're taking. What are the factors that banks and lenders use to assess your loan application and borrowing capacity? So each lending company will have its own set of metrics and qualifications for assessing your loans. You know, one bank may approve you for a loan worth 80%, one bank may approve you for a higher loan, say 90%, and a third lender might just reject you altogether. So there's no absolute rule or formula, but most lending companies use a few factors. So your borrowing capacity, that's the estimate of how much you can afford to borrow. They look at, your yearly income. They look at your expenses. They look at the number of dependents you have, the amount of proven savings you have, which is different from the amount of money you have. And they'll also look at the size of your deposit. So all of these things are compared against the type of loan you're looking for, and then they assess whether you can afford it or how much they're willing to lend you. They'll also look at the purpose of the loan. So if you're looking to use the loan for investment purposes, then that puts you in good stead because they'll look at, the rental income or part of the rental income as well, whereas they wouldn't, add that onto your borrowing capacity if you were buying a home for yourself. They'll also look at property prices in the area and do a valuation on the property to see if it's worth what you're paying for it. Because they want to know that if you default on your loan, that they can sell it. And if you're buying in a remote area, then the majority of lenders that I've seen won't lend past that 80% mark because of fluctuations in smaller areas and, the longer lead time to sell and things like that. A few items just to be cautious of when applying for an investment property loan. Your credit history, it may be fine, it may be good, but every time you apply for a loan, they'll probably check your credit history, and that credit check gets marked as an activity on your credit history. And some lenders are going to automatically disqualify candidates who have multiple activities on their credit history, even if they're not bad ones. You've got to be prepared that commission, if your part of your income is commission, then many lenders will only consider your base wage and won't look at your commissions, even if you get them regularly. So you may be earning $100,000 a year, but they might only judge you on your $50,000 a year base. However, there are some lenders who actually look at your actual earnings, so seek them out if you're having any difficulties. Mortgage brokers. I think mortgage brokers are great. They offer a free service to help you find a suitable loan. But just be aware, mortgage brokers are paid by the lenders for securing the loan. And some lenders pay more commissions than others. So consider their advice, but always do your own research because the mortgage broker might be pointing you towards a loan that's better for them, but not necessarily better for you. Proven savings. Many lenders will look for proven savings, and this is money that you have actually saved yourself. So not the first home buyer's grant or not a gift from your family or friends or whatever. Many lenders count money that has been in your account for 3 months as proven savings. So you may be able to get a gift from, say, your family, keep it in your account for 3 months, and presto, they'll count it as proven savings. But every lender is different. Be careful affording your repayments because your repayments aren't the only thing you'll have to pay back for investment properties. There's things like maintenance, insurance, management fees, council rates. So make sure you take all these factors into account. And also be aware of credit cards because the greater your available credit limit on credit cards, even if your credit card's empty, will potentially lower your borrowing capacity. So I've heard that lenders will take away, $4,000 to $5,000 for every $1,000 credit card limit you have, and some lenders will go as far as to lower you by as much as $20,000 in borrowing capacity for every $1,000 credit card limit you have. So if you've got heaps of credit cards, then be careful with that. You might need to lower it. And look, if you want a calculator to give you a rough idea, then I've got one that I recommend, which is on my website on the page down the bottom, and that one's great because they don't ask you for your personal details and things like that, which a lot of companies do, so then they can follow up and try and sell you a loan. They'll actually just give you a recommendation on the spot without committing to anything. So I hope that helps. This was just a quick video about how much can I borrow from an investment property, and I hope that helps to answer your questions.